Right now, as you're watching this, Trump's advisors are on the phone with Beijing. Not about tariffs, about oil. They're asking China to help reopen the Strait of Hormuz before Trump even sets foot in Beijing next week. Think about what that actually means. The most powerful country on earth calling its biggest rival, asking for a favor before the negotiation even starts. That's not a side story. That's the whole story. And here's where it lands in your portfolio. If you hold any emerging markets exposure, even just through a standard index fund, what happens in Beijing on May 14th could be the single most important event for those holdings all year. By the end of this, you'll have a framework, one that tells you exactly which scenario is playing out before the market has a chance to price it in. May 14th. Donald Trump lands in Beijing. First U.S. president to visit China since Barack Obama did it back in 2014. But here's the thing. This meeting was already canceled once. Trump pushed it back from late March because of the U.S.-Iran war. He needed to manage that crisis before he could sit down with Xi, and Beijing still hasn't officially confirmed the new dates. Not publicly, not as of today. That silence is deliberate. It means China controls whether this summit happens at all. On the surface, this looks like two superpowers negotiating from equal footing. Look closer, and it isn't. Trump's problem. The tariff truce expires in November. Without a deal, tariffs snap back to 145%, the levels that nearly broke supply chains last year. And in February, the Supreme Court limited his authority to impose tariffs unilaterally. That ruling handed Beijing something it didn't have before: legal certainty that Trump can't just decree the next round. He has to negotiate. Xi's problem: China's export recovery is real, but fragile. April's PMI beat expectations. Export orders rose above 50 for the first time in 2 years, but a lot of that growth is goods being rerouted through Vietnam and Malaysia, not going directly to the U.S. That's a workaround, not a recovery. Chinese factories need genuine tariff relief. And the November cliff edge is just as real for Beijing as it is for Washington. Now, here's what makes this summit genuinely fragile, and what almost nobody covering this story is talking about. China imports a third of its oil through the Strait of Hormuz, the same strait that's been under threat for months because of the U.S.-Iran war. If Trump visits Beijing, then resumes strikes on Iran, China looks like it gave diplomatic cover for an attack on a country it has deep energy ties with. That's politically toxic for Xi at home. This is why Wang Yi, China's foreign minister, called Tehran this week, urging a ceasefire. Not out of principle. To clear the runway for a summit Beijing needs, but can only attend if the Iran optics are manageable. Trump's advisors calling Beijing about Hormuz isn't a side story. It's the negotiation happening before the negotiation. Now, let's talk about what this means for your money. Here's what most summit coverage gets wrong. Everyone watches the handshake, the press conference, the photo op. Smart money watches the positioning that happened weeks before. Because by the time the cameras are rolling, the trade is already on. Here's the part most investors haven't seen. European institutional investors have been quietly adding China exposure throughout 2025, while U.S. investors fled. That divergence is now worth hundreds of billions in unrealized positioning. It closes fast when sentiment shifts. The investors on the right side of that trade didn't wait for the summit. They positioned for the signal. That's the game. Now here's the map. If the summit delivers, even partially, the clearest winner is Chinese equities. Specifically, Hong Kong-listed H shares, which foreign investors can access most easily. Here's the mechanism. The single biggest weight on MSCI China's valuation right now is geopolitical risk premium. When that premium compresses, the re-rating is fast. Alibaba, Tencent, BYD. Not because their businesses change overnight, because the discount applied to them for geopolitical risk gets smaller. In the US, watch Boeing and Caterpillar. China has placed large goodwill orders at every major summit since 2009. Expect an aircraft or soybean headline at the press conference. The number is designed for a news cycle, but the stocks will react to it anyway. The sleeper play, MP Materials, the only US rare earth miner of meaningful scale. If the summit formalizes China's rare earth export suspension into a multi-year agreement, the defense and EV supply chains scrambling for alternatives get repriced. Now, the one sector that loses on a deal, the China +1 trade. Companies that spent 2 years building Vietnam, India, or Mexico capacity on the assumption that China tariffs stay high. Their urgency narrative weakens if tariffs fall. Not a disaster, but the thesis gets harder to sell. And the biggest risk if the summit collapses? It's not China stocks. China is 30% of EM indices. A summit failure reprices China risk upward, triggering forced selling across EM funds, regardless of what those funds actually hold. Add an Iran escalation on the same day, and you get an oil spike layered on top of EM outflows. That combination hits more portfolios than most investors realize. So, what do you actually do with all of this? Here's the honest answer. Probably nothing. Not yet. You wait. But you wait with a framework, so that when the moment comes, you're not reacting to a headline at 6 in the morning. You're executing a decision you already made. Before the scenarios, one number that puts everything in context. MSCI China is trading at roughly 10 times forward earnings right now. The US market is at 22 times. That gap, that 12 multiple gap, is the geopolitical risk premium made visible. Every point of tariff certainty this summit delivers compresses it. Every point of escalation widens it. The summit is essentially a vote on how big that discount should be. 3 scenarios. They escalate. Scenario A. A comprehensive deal. Probability, 15%. Tariffs fall below 20%. Rare earth controls formalized. A tech guardrails framework agreed. Chinese equities re-rate 15 to 25% over 6 months. U.S. institutional money that's been underweight China starts deploying. This is the scenario most investors are hoping for, and the least likely. The signal? One word at the press conference. If Trump announces a specific tariff number, that's scenario A. If he says framework for continued dialogue, it isn't. Scenario B. Transactional wins. Truce extended. Probability, 65%. Boeing orders. Soybean purchases. The tariff truce extended through 2027. Markets get a relief rally, 5 to 10% on Chinese consumer and tech stocks. Then it stalls. No structural re-rating. The geopolitical discount doesn't disappear. It just shrinks for 1 quarter. This is the most likely outcome. It's also the hardest one to make money from, because the move happens fast, everyone sees it coming, and positioning into the press conference is already crowded. The investors who profit from scenario B are the ones who were already in before today. Scenario C. The summit collapses. Probability, 20%. Iran resumes fighting. Beijing pulls back. Or the meeting produces no joint statement. The diplomatic equivalent of an empty handshake. The canary here is Beijing's silence. China still hasn't officially confirmed the May 14th dates. If that confirmation doesn't come by May 8th or 9th, this scenario is repricing in real time. Don't wait for a cancellation headline. Watch for the absence of a confirmation. 3 signals to track before May 14th. 1. Beijing's official confirmation, or continued silence. This is the most important leading indicator on the board right now. 2. Wang Yi's next public statement on Iran. A ceasefire call means the runway is clear. Silence from Wang Yi means Beijing is pulling back. 3. MSCI China options implied volatility. If it rises into the summit, institutional money is hedging tail risk. If it falls, the market is pricing in a deal. That's smart money telling you which scenario they believe. The summit isn't a negotiation between 2 presidents. It's a negotiation between 2 risk premiums. And one of them is already sitting in your portfolio. May 14th. Trump lands in Beijing. Watch the press conference, not the photo op. A specific tariff number, scenario A. Productive dialogue and a framework, scenario B. A canceled flight, scenario C. You have the decoder now. But here's the part to hold on to when the cameras are rolling. By the time Trump and Xi are shaking hands, the most important positioning decisions will already have been made by investors who read the signals before the summit, not after. You just read the signals.